Hi there, I just had a great conversation with Glen Bertram, who's the head of Asset Allocation and Portfolio Management at JBWere NAB Private Wealth, and we spoke about how the federal budget has influenced his thinking in relation to Australian assets. Indeed, we spoke about the recent run-up in long-term interest rates and what that means for portfolio structure. We also chatted about the latest developments in the AI space and whether or not we're closer to a tipping point when it comes to energy prices. Have a listen, you won't be disappointed. Glen, as a portfolio manager, asset allocator, still a heady mix of influences that are driving markets of all stripes. What do you boil it down to in terms of what keeps you up at night?
Honestly, Tom, thanks for having me again. But for me, there's just one thing at the moment really keeping me up at night as a portfolio manager and asset allocator, and that's the observation that there's just one trade really that's driving global markets. So, like we wrote about in our last research piece, we can distill it down to only 8 stocks that have driven all the gains globally on a year-to-date basis. They're all driven by AI. So there's huge concentration risk in markets. Even from a domestic perspective, you've got Commonwealth Bank and BHP, 2 stocks that are 20% of the market, 2 sectors, materials and financials, are 60% of the market. Offshore, broader technology, the way we characterize it in the US, 60% of the S&P, hugely concentrated benchmarks. So the challenge now is there's one thing driving them, tech and AI. You can be there and you can participate, but it's quite concentrated. And if you're not, obviously the challenge is you run the risk of underperforming major benchmarks.
So the real challenge under those circumstances is how you balance the portfolio. What's been interesting since we last spoke is that bond yields have actually moved materially higher. And now I'm interested in how the equity and the bond piece competes in your thinking under those circumstances, given how attractive bond yields have become.
I think that's right. Fixed income yields are attractive, and that asset class is attractive. So real or inflation adjusted returns in fixed income are amongst the best they've been in 20 years. So we'd concur with that. I mean, the interesting thing is there's one major issue that's driving that outcome in the short term, which is, in our view, which is what's happening in the Middle East and concerns around the inflationary impacts of rising energy prices and maybe the duration of how long they stick around for. But on the other side, it's pretty interesting that in equity markets, they've just looked through all of it. They've just said, we're gonna basically look through whatever the valley is and look long term. So that's the risk. You've probably got 2 different markets that are looking at a different outcome.
So Glen, a really important feature of those rising bond yields is the calendar movement forward in relation to the way that global energy inventories are being drawn down on. That's not a big topic of conversation. It's happening as fast as it's ever happened at the moment, with around 5.5 million barrels per day being consumed. When is the moment where the markets start thinking differently about that?
Yeah, that's the question, isn't it? So when you get closer to the energy experts, I mean, some of them even estimate more than that has been the drawdown. So obviously what's been happening now for a couple of months through the Iran conflict is that oil prices have not skyrocketed more than they have because global inventories are getting drawn down. So depending on whose estimates you're looking at, somewhere between 1.2 and 1.5 billion barrels have been drawn down. It's clear that China has plenty up its sleeve, but ultimately the total inventory levels are unknown. So everybody's trying to second guess at the moment, where's the pinch point, where this really starts to bite. And like we sort of said before, I think the equity market's just basically saying US political appetite to find that point and not retreat before we get there is limited from a domestic political context. So we'll just run with it and basically focus on the AI trade and corporate earnings.
And then wait for things to happen, including the potential for a taco trade.
Well, yeah, I mean, I think the equity market absolutely expects that.
In terms of the federal budget, I mean, there's a lot of noise around the budget, but again, as an asset allocator, signals are some of the most important things that you gather from the market. There was a very clear signal in relation to the way this administration views capital compared to labour. How has that influenced your thinking?
Yeah, it's a good question. So, I mean, the biggest. So, firstly, what's the government trying to do with the budget? Clearly, they're trying to level the playing field a little bit. They say between capital and labour, although we would say, the quid pro quo for these taxation changes should have been more meaningful cuts for income than what's been put on the table. Yet that'll come in the run up to the next election. But the way we're looking at it actually is the biggest impact is the government's trying to ultimately take a bit of the impetus out of property investment outside new build. It wants to direct the investment into new build to increase supply, take a little bit of the impetus otherwise out of what would have gone into property investment. We think some of that at the margin will obviously find its way into fixed income that we spoke about, but arguably some of it might find its way into the equity market as well. So we're not all that negative off the back of the budget for the outlook for domestic equities, but it is interesting, and the main impact for us at the moment has been in the lead up to the budget and since, Australian equities have actually underperformed very materially. So investors out there are taking a view that seem to be taking a view that this is net negative for the local market. Maybe they're worried about bank credit growth, like investor lending's been a big part of that, and that feeds through to revenue and ultimately earnings for the banks. But actually broadly, I think we would say that domestic equities relative to offshore look like they've overcorrected. Valuations are now much more reasonable by comparison, and we'd be kind of taking the other side on that a little bit, I think, at this point.
I mean, another important consideration, again, it's probably at the margins, but it's a thought worth reflecting on. Will global capital allocators think differently about a jurisdiction that doesn't favour capital?
I don't think so, because the changes won't apply to them. I mean, in terms of equity market implications, the government's already been at pains to explain that they don't see material implications for the local market because the biggest two investor cohorts are foreign investors and domestic superannuation, and neither of them are affected. I think the marginal questions are really for domestic investors and certain types of domestic investors, and will they favour income generating, high yielding stocks over growthier stocks, and will they similarly consider maybe re-onshoring some of their offshore exposure back home, because most of our clients would put some of their growth capital offshore, tend to be higher growth markets, and the local market is a higher income market, which is less affected by the budget changes. But honestly, we'd be really careful with that, because in our view, starting points are really important here, and the starting point here in the local market are that our growth stocks, the growth segments of our market, have already been whacked really hard. And I think that's sort of crucial to pay attention to. And just very briefly, the reason for that is that globally, investors have basically put growth stocks into two buckets. They've either said you're a winner from AI and from the trends in AI, or you're a loser. And it just so happens that the market's taken the view that a lot of the companies that are listed in Australia are on the wrong side of that trade.
In terms of the tweaks to the portfolio in recent times, you've trimmed a bit of the energy exposure, albeit off a fairly high level, and you've sort of added a little bit of REA as well to the portfolio.
Yeah, so they're two important points. So we've been holding, or we were holding, pretty meaningful exposures to energy for exactly the type of risk that's played out. But it's important to understand as well, it's just all part of running a more balanced exposure. So over a couple of decades, we've gotten to the point now where a sector like energy is a tiny proportion of the market. And conversely, sectors offshore like tech are huge proportions of the market. So if you're following a benchmark like exposure, you've got very skewed exposures and a lot less diversity and balance. We've gone the other way and run much more balance. I think on the reductions in energy, it's just a reflection of the fact that the reason that we hold those positions in portfolios to keep portfolios solid in times like what we saw in March have played out, or largely played out, we think, i.e. geopolitical risk. So, so we're reducing some of that exposure mechanistically. On the REA story and just platform companies more generally, there've been a lot of platform or marketplace type companies globally. So REA, car sales domestically, globally, businesses like perhaps booking.com, something like that, where the market's basically put them in the AI loser bucket. Our view is that some of those models are going to be much more robust to the trends taking place in AI, and actually some of them might benefit from what's going on. So we see REA in that category. We see it as pretty well placed, just taking advantage of basically some weakness in share price to top up.
Glenn, it's always good talking to you. Thanks for your time.
Thanks, Tom.